Are live on all channels, or at least the ones that we're aware of. Let's dive right in here. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. Today, I'm joined with my good friend Doug Hagerin. Hey, Doug.
Hey, Kirk. Happy Friday.
Happy Friday. And it's funny, we labeled next week, and just for the listeners, for those of you who follow us live on these episodes, we pretty much label our episodes a week in advance. So we really don't, we're just guessing on what the topic's going to be. So sometimes we're really off. And we labeled next week the one we probably should do for this week, which is, I won't get into because I don't want to ruin the surprise. It's called I Was Wrong. I don't want to get into that this week because I don't want to spoil it, but I do want to share this one image. So Jerome Powell spoke this week and the markets reacted in a big way. And I just thought that if any of you, so I don't know about you, Doug, but this concept of the simulation, have you heard of the simulation before?
I have heard of it, Kirk, but I'm sure a lot of people haven't.
Okay. Well, the concept of simulation is actually more of a philosophical thing. So there's some techie geeks out there that came up with this, and it's really hard to dispute. So it's kind of interesting. It's like saying, does God exist? And it's like saying, are we living in a simulation? And anyway, if you haven't looked it up, look it up. It is fascinating. It kind of like blows your mind every time you think about it. And every once in a while, I just think, like, are we living in a simulation? And maybe I'll spend 2 minutes to describe it for those of you who haven't understood. But I want to share a picture that just proves the simulation has a sense of humor. So the idea of the simulation is that we all live in a simulation. This isn't real. This is actually a simulation. It's like we're living in digital world, but we're not. It's like NPCs, right? You play a game as an NPC. They say the same thing over and over again. And those people in your life, the NPCs who say the same thing over and over again, they never learn. They just keep repeating it.
It's called Twitter.
Yeah, Twitter. There was actually a movie similar to this. I forget what it was called. It was Jumanji, the newer Jumanji movies, where they come and there's a guy and they're like, hey, and he says something and you say something and he repeats the same thing over again. I mean, it's hilarious. Anyway, the point is the philosophy is that if we're smart enough that we can start creating a simulation, it means the probability is such that one already exists and that we're in it. Right. And so if you look at and it's really just a math problem. It's like basically the probability is such that if it's possible to create one, the probability is such that we're already in it, that we're not the first civilization to create it. So it's just more of like a math thing. So it's just interesting to think about. Anyway, every once in a while I hear people talk about it. I'm like, it's pretty cool. It's a cool idea. And then I see this. So in the New Jersey T or train or whatever transit system, apparently a bull was loose running around the transit system. Now, this is a day after Jerome Powell got out and spoke, which caused the markets to shoot up because of what he said. And then a bull gets loose. Where is there a bull in New Jersey? I don't know. Is there a farm running around? Like people are just like, oh, the bulls escaped. Like, how did this?
You're typically not going to see longhorns in New Jersey.
Exactly, and longhorns to boot. Like, where did it even come from? It's just like, to me, it's just the simulation laughing at us. So that's why I bring up the simulation. Not that I believe it or don't. It's just like an interesting mind experiment. But for God's sakes, if we're living in a simulation, that is a simulation having fun with us. There's a bull running around right the day after Jerome Powell spoke. The bulls are running. I mean, it couldn't be more. It couldn't be more on the nose. And that's all I had to share. I just couldn't stop laughing at the fact that this actually happened. And those of you who weren't paying attention on Wednesday, when Powell came out and spoke, basically caused the markets to go up. I don't know, it was a few percentage points, but the markets are already kind of overstretched, and then all of a sudden, wow, there we go, and the markets just shot right up because effectively what Powell said is, hey, we're going to decide to start thinking about lowering rates. And, I'm thinking to myself, this guy wants to be Volcker, and he just marked himself as Burns.
That's what I was thinking.
I mean, Jerome Powell, you are no longer chasing the shadow of Paul Volcker. You are now chasing the shadow of Arthur Burns. And for those of you who don't know what happened to Arthur Burns, just look at what led up to what Paul Volcker had to fix. That's all I have to say. If you want inflation close to 20%, if you want, I mean, you might want 30-year treasuries at 15, but if you want mortgages at 20%, I think CPI was like 18 or 20, somewhere there. Anyway, if you want that, hire Paul Volcker. I'm sorry, not Paul Volcker.
Arthur Burns. Yep.
Jerome Powell to mimic Arthur Burns in his pursuit for mediocrity. That's all, that's all I have to say.
I think the simple way is, do you want the 70s or do you want the 80s? And there's lots to complain about both of them, right? But the 70s were pretty rough.
Except the 80s are pretty good for rock and roll. I was saying pretty good rock and roll in the 80s. But yeah, I mean the 70s, not a lot of great stuff came out of the 70s, except for great stories and anecdotes that we can use on the show. So, but really kind of getting into things, I did want to tap into some of our conversations. I had this laundry list of mental models that I want to continue to go over, because really these mental models are the infrastructure that our thinking is built on. And so if you don't understand these mental models, then you'll be doomed to repeat them. Now, there was a thing I want to talk about bonds at one point, but let's talk about, here we go. This was actually from the Seth Clarence, where is it? Forgotten Lessons of 2008 from Seth Clarence. So I wanted to just dip on one of these once in a while. So it's one of them is, risk is not inherent in an investment. It is always relative to the price paid. Uncertainty is not the same as risk. Indeed, when great uncertainty, such as the fall of 2008, drives security prices to especially low levels, they often become less risky investments. Now, I want to talk about this for a second, because we are at a place where the stock market is at levels that I'm scratching my head wondering, what kind of crazy kook is willing to pay these prices for these stocks? Apparently enough of them, and the majority, or else the prices would be a lot lower. And so if you think about this holistically, right, and I'll pull out a security, but this is a holistic experiment. It's not to mark this security. But you look at something like NVIDIA, right, which is up some few %100 this year because of AI, in large part because of AI. And now you look at a security like that, and you could say, well, if it's trading at a PE of, I think at one point it was a PE of like 199 or some crazy number like that. If the PE is trading at like 200, how long is that going to take for the stock price to your earnings to pay you back in that stock price? Well, it'll take about 200 years, right? And so right now, the PE ratio is 64, right? Now, you could argue that the shooting up of the stock price was accurate because the numbers were not reflective. The past numbers were not reflective of the future, which would be correct. It was close to a 200 PE. Now it's close to a 64. So the growth people were relatively right. However, there's an assumption built in there that the growth is going to continue at this pace, which, obviously there's a lot of smart people pegging this, but we really don't know. So when you get into the price mechanism of a stock or stocks, the stock market as a whole, you have to take into a lot of factors, right? And if you're a value investor, you understand how to value stocks. If you're a growth investor, many growth investors are more momentum based, and they're not right or wrong. I know everyone's got their thing, and they're it's like a religion. You're never going to tilt them off their axis, and that's fine. But you should understand that if you're overpaying for stocks, it just means that your future returns are going to be a lot less. So would you rather buy stocks in January of 2000, or would you rather buy stocks in March 9th of 2008 and 9? Doug, we hear your thing there. Just
weird. Yeah. Sorry. No, I don't know how that's happening.
Okay,
sorry.
No worries. So anyway, I just want to point this out, because what we're looking at here is a stock market which is trading. Some markets are trading at all-time highs. Some stocks are at all-time highs. They're right around the barrier. So some things have broken out, some haven't. So we're going to see what happens in the next 2 weeks from here, whether that continues or whether it's a false breakout. Which, if it's a false breakout, be prepared for carnage, because what typically happens if things break out and then they bounce back below the breakout, it means that it's just a trick and that everyone's going to start selling. So just be aware of that. That is something to be mindful of. But the reason I wanted to talk about this number 4 in his 20 lessons is that if you're paying for a stock in 2009, inevitably it's going to be really cheap, and that your returns are going to be much better than your returns if you're buying them in January of 2000, right? When things were way overpriced, tech stocks were trading for multiples of negative earnings, like things that just shouldn't happen, and yet they did happen. And so one big tech stock at the time still hasn't exceeded its all-time high, and that's how expensive it was. It was, I think the PE was some crazy number, it was like in the hundreds, and it still hasn't exceeded it. So this is a lesson. I don't want to necessarily bring up this stock. I haven't passed on the show, but I don't get in trouble. And maybe I will at some point. We'll contextualize it better. But this stock has not exceeded all-time highs from back then because it was expensive back then, and the earnings haven't grown to get to the level it was 24 years ago. And this can happen. So if you're buying stocks in the bubble, in the peak of the bubble, it's going to take you a long time to make your money back. So the point of what I'm saying is not you should not invest in the stock market, because based on Jerome Powell, that we could very well see the next bull run another 50, 100% higher. We could see that, right? And I think any market you look at, you can't say, well, this is going to happen. Well, maybe you're a fortune teller. Maybe you can see the future, right? Maybe you're a gypsy. I don't know. I can't tell the future. Maybe you can. But no one I know can tell the future. So anyone who sits there and says, well, this is going to happen, is basically telling the future. So I'm always mindful of the fact that, hey, I really don't know what's going to happen. All I do know is that if I'm looking at investing and I'm looking at different scenarios and I'm saying, well, what are my odds of success here? My odds of success in a market like this is much higher if I buy stocks at a low price. And I mean stocks, not like penny stocks that are dirt cheap. I mean a high quality company bought cheaply, right? Or I forget the Munger and Buffett quote is, I'd rather buy a high quality company at a reasonable price than a cheap company of reasonable quality, right? And effectively buy the best stocks at a good price rather than the worst stocks at a cheap price. And I think that holds true. And right now, you're overpaying. And this is why Berkshire Hathaway sits on enormous amounts of cash, especially right now, because they don't know what to do with it. It's not that they don't know what to do with it. They know exactly what to do with it. They're just waiting for the opportunities because they know eventually they're going to come. And let's say the stock market does 20% a year for the next 2 years, and you're sitting in cash and it's getting zero. But then the stock market drops 60%, and you're still sitting in cash. You're so far ahead of those other people that it's not even funny. You didn't miss out, right? You didn't miss out on that 20%, because you bought things dirt cheap. Remember Warren Buffett, Doug, was buying in 2008, 2009. He was buying, I think he bought like Tiffany's, he bought Harley Davidson, he bought
Burlington Northern.
That
was a huge purchase.
Yep. He got warrants and a special deal on Bank of America, I believe. He got it on Goldman Sachs. He got it on a handful of other companies, but he got a special deal with these companies where he got paid like 15% a year, somewhere in that range. I forget the specific. Each one's different. Around 15% a year, plus warrants. If the stock goes up, I'm going to benefit from that. We don't get that kind of a deal. Only Warren Buffett gets that kind of deal because Warren Buffett is the master bailout mechanism of Wall Street. People say, well, the Fed bails them out. No. Warren Buffett is the bailout mechanism because Warren Buffett comes in and says, I love America. I'm going all in today. Everyone's going to be like, maybe my math is wrong. Uncle Warren has it right. And we know what Warren's always right, even though he's not. But we always know he's right. So we're gonna second guess our thinking. And you know what? We're gonna go all in too. And that causes the rebound in the markets, and everyone all of a sudden has confidence, even though March, I don't know if anyone remembered March 2009, we didn't know if our banks were going to be safe. Like no one knew things were safe, even though that was the bottom. People just got to the point where like, it's cheap enough so that even if the world implodes, we're still going to be okay. That's how cheap the market was. And if you had a strong enough stomach to do that, you were a hero. I don't know anyone who did that. We started buying there, but we were not a hero being going all in. That was crazy. But it would have been nice to have done that. But we will.
Well, and I recall people saying Warren Buffett was an idiot. Look how wrong he is, because after he bought, the market went down a little bit after that, a little bit.
It did. Yep. January, February, March, it went down, then it rebounded. So just understand that valuations do matter if you're thinking the long term. Now, if you're an indexer, you're a buy and hold or buy and forget, buy and hope kind of investor, valuations matter more to you than they do to me. They matter more to you because if you're going all in at the high, you're buying and holding. You got to wait. January of 2000 to July of 2013, the market went nowhere. It went down for 13 years. It only got to the peak around July of 2013. That's when it got to the former peak in the S&P 500 from January of 2000. You had to wait 13 plus years to get your money back. So if you're buy and hold, you're in much worse shape than anybody else. Now, if I'm more nimble, like I'm more agile in how we do things, so we manage risk. So if we think, hey, this is going to get really ugly, we'll get out. We'll wait, right? Like right now, I'm happy to sit on 5.5% rate of return for virtually no risk in U.S. Treasuries. That's not all we're in, but that's one of the big things we're in because as a risk-to-reward trade-off, it's a no-brainer. But if you get into the aspect of, well, what should I go all in? I don't know. It depends how long you want to hold to get your money back. Like I think right now is just expensive. Now, this doesn't mean you sell and this doesn't mean you buy. That's not my point. My point is context for valuations matter, right? And when you're buying something now, like any tech stock, Apple, Microsoft, Nvidia, Tesla, whoever, the Magnificent Seven, if you buy one of those now, you're basically at a higher risk endeavor than if you were to buy it in March of 2009. It was a much lower risk endeavor. And risk was calculated by the price. Because if you're overpaying, then your risk is higher than if you're underpaying, right? It doesn't mean the quality of the company has changed. The quality of the company might be the same, but your investment has changed. Because if you're buying it at $10 and it grows at, well, let's say you buy it at $20 and it grows at 10% a year, right? So it grows $2 a year in stock price. Every year it grows $2, right? Or somewhere thereabouts. But you buy it at $10, well, now you're not getting a 10% return. Now you're getting a 20% return a year. Your returns are massively dictated by the price you pay for that investment, especially if you're buy and hold. Now, if you're just buying and selling, valuations don't really matter to you. But the inherent risk involved is much higher if you overpay and it's much lower if you underpay. Even and if you look at the stock market, the best time to buy was March 2009. It was the lowest risk time you could have. At the same point, the world was imploding. You didn't know if your bank cash was safe. I mean, it was disaster out there. I remember this vividly because I was paying attention. I wasn't just, sticking my head in a hole like a lot of people were then. I remember that time vividly. Like everyone's reactions, it was like it happened yesterday. And I remember how people reacted. And people were scared crapless. I don't know swear in the show. I guess that's close to not swearing. People were scared out of their minds at that time. Absolutely scared. I was talking to my partner who used to work at Citigroup, and he was like, it was trading at $1. He's like, yeah, I'm going to buy some. I'm like, dude, it could easily go bankrupt. It's like, look at it. It's a disaster. Like everyone knows it's a disaster. He's like, yeah, but it's $1. I mean, but buy 100 shares, whatever. It's $1. And I was like, well, let's look at the options. And I was thinking to myself, wait a minute, $1 is an option. Like at that level, trading for $1, like that is an option. I looked at the options that were trading like 80 cents. I'm like, what's the point of an option at this point? It truly is an option, trading at $1. Ended up doing okay, but the point being is the valuations matter, and we all need to consider this because right now we're having a Santa Claus rally. Everything's going up. Everyone's feeling great. Oh, we're all making lots of money. It's hunky dory, and you might wake up January 2nd and realize the stock market is going down and valuations did matter, and oh crap. So I don't know. Doug, thoughts? Oh, Doug, you're muted.
Thank you. I saw some the other day with you were talking about the cash and Warren Buffett having flexibility and listen, the reason that he's the great savior, right? Of course he does it purely through philanthropy, right? Right, Kurt?
Oh yeah.
But obviously, he has more liquidity than banks and governments in many cases to be able to make moves strategically when it matters. And he has said repeatedly, and I know I won't quote it perfectly, but he has said, "Why do I sit on cash?" Because we all know this. He's gotten multiple complaints at different times and different periods where people have said, "Look, when you're sitting on too much cash, you're hurting the return of Berkshire Hathaway, right? Because cash doesn't earn what the stock market could earn." And they've asked him, and he's basically said, "Look, it gives me options tomorrow." And those options are extremely limited. If you are, as you talked about, if you're just buy and hold and long term, you're at more risk, because not only is the issue of having to wait for that time, but it's also the issue of having no liquidity or limited liquidity to be able to capitalize on opportunities that might come up. Okay. So if you're fully invested, you're writing all that asset value down. You have to sell that asset to be able to go buy the other assets that are depressed. So I saw a tweet yesterday or the day before that said, where someone basically compared QQQ, which is the NASDAQ, SPY, and cash. And they said, and I can't remember what QQQ was, but it roughly was like, okay, QQQ this year is up, 60% or whatever it was. And I may be wrong on this. Don't quote me. And they're like, the S&P 500 is up 25%, or 18% or whatever it was. And then they're like, cash up 5, and they're basically like, cash is trash. Like, okay, in a 1-year bubble, you might be able to make a good argument. But why don't we go to a 2-year bubble, right? Why don't we actually look at, had you been sitting fully invested in 2022 and you had gotten, say, 5% or 4% cash or bonds during that period when they started raising interest rates, or raising interest rates on that cash for 2 years. So you've got 5% average per year. Well, listen, between 2021 and 2022, 2021, the S&P 500 total return was 28%. In 2022, the return of the S&P 500 total return was minus 18%. Now, that is an average 5.3% over those two periods. So if you listen to the meatheads out there, and I'm going to call them the meatheads because they just rattle off numbers and statistics that they don't always understand, they're going to say, look at this wonderful average return of 5.3. It beat it. Okay. The actual rate of return on the same period was 2.66%, because that's what you actually would have earned, not just by averaging the two returns together, but your actual growth on your money, 2.66. So if you take that 2.66 and add it in and just took 2022 into 2023, and you lost 18% last year. And we talk about this, and I think we have a chart actually. This would be a good segue on this, Kirk. But if you take the minus 18% last year and you ride into 2022, 23, and you're going to go out there and make a meathead comment that says, look, the S&P 500, look, it did 18% this year, cash is trash. Well, the reality is, if you lost 18% last year and you only did 22% or 20% growth this year, Kirk, are you back to zero? The answer to that is mathematically no. Okay, so you're looking at a 1-year bubble and you made great returns. But ultimately, and I'm having a little bit of screen issue, but how much is an 18% decline? What does it take you to get back to from that loss? Does it say on there? About 20%?
20% loss is 25% gain to break even.
25% gain to break even. So if you lost 18% in 2022 and you're bragging about making 18% this year, are we back to zero, Kirk? Nope. And hey, if you were sitting fully invested that entire time, maybe you're just dollar cost averaging a little bit of money. By the way, dollar cost averaging is not buying the dip. Okay. Buying the dip is what a lot of people brag about. It's like, I'm going to buy the dip. No, that's not, dripping money in every payroll. That's dollar cost averaging. That's not buying the dip. Buying the dip is, I am going to wait for the dip and I'm going to buy it. Now, there is good buying the dip and bad buying the dip, and we can go back to the the rules of 2008 to talk about what buying the dip is. But the point is, let's say it's a really big dip. Let's say it's a 20% decline in the market, and you want to be able to buy it, and it makes sense, and the valuations are good. You want to go in and buy it. If you're fully invested and you're just doing your little drips, that's not buying the dip. That's dollar cost averaging. And so not only have those people not recovered over a 2-year period, they haven't had the liquidity and the flexibility because cash is trash to be able to capitalize on that. So, I will remind people, you'll see and hear a lot of things that we talk about. Kirk, there are truths, untruths, and what's that middle one called? Half truths. Averages, average return is not the same as actual return. Buying the dip is not the same as dollar cost averaging. And by the way, yes, I know 2023 might be up 20%, but over a 2-year period, you still take it. You still got smacked in the face. So understand, cash isn't trash. Cash is a tool that gives you flexibility.
Cash is king. That's why I like to say it.
It is.
And having Ray Dalio say cash is trash, I love the fact that he said that, because it's, in some ways it's true. In some ways it's a half truth, as Doug said. It's also not true. So, but yeah, I mean, looking at this, I mean, look, like we've been predicting the market could drop 40 to 60% in a bad recession. Like, I think that's a very realistic sell-off number to get to a place that's a little more reasonable valuations. I'm not saying it's going to happen, right? I don't know what's going to happen any more than Doug does or anyone listening to the show, right? I'm not a gypsy. I'm not a future fortune teller. So I think we have to be mindful of the fact. But when we look at it, we're looking at what's the worst case scenario. I mean, that's part of our job, right? We're risk managers. What is the worst case scenario? If everything works out, we have nothing to worry about. But if we don't worry about the worst case scenario, then when it happens, we're not going to be prepared for it, which is why we prepare for it. And, it's like, what do they say? Prepare for the worst and hope for the best, right? If you, I'm going to crib the quote, but it's something like, if you want peace, prepare for war, right? Like, great. We all want peace, but prepare for war, because you don't know what's going to happen. And I think it's the same thing here. If you look at this chart, if the market drops 40%, you got to get 67% to get back to where you started. If the market drops 60%, you need to get 150% to get where you started. The lesson here, don't lose 60%. Like, 150% is a lot. Now, granted, in the market in the last few years, hey, it's not so bad. Just buy some NVIDIA and pretty much Magnificent 7. You would have made 50% this year. I mean, crazy numbers. And I'm still scratching my head for how this happened. One of the stocks that was, it's had nothing but bad warnings and whatnot because of their supply chain. And yet the stock's close to all-time highs right now. I'm just scratching my head thinking, did people forget that they've got supply chain issues that they've warned and they still haven't hit the tape yet? Like, what's going on? People don't care. Santa Claus rally. Buy all in. We don't care. We're not even going to look at what we're buying. Just buy. And I think this is the problem that people are facing right now. And so if you're an investor, I'm not saying you shouldn't take advantage of the next 2 weeks or 3 weeks, because I'm thinking of that myself. Like, hey, what can we do in the next 3 weeks to take full advantage of this? But at the end of the day, you have to be mindful of the fact that really we're kind of pushing the envelope. We're in one of these tails. These it's not even a tail risk, but a tail return, where on the upside, it's like, wow, this is really taken off. And I'm going to take some money off the table because this is getting a little scary. I'm starting to hear that a lot from investors. And I did want to share this chart crime, which I saw this and it was, I thought it was brilliant, but I have to share this chart crime because it's so bad. We talk about in the show on mindset and how to look at things, and statistics lie, right? And statisticians lie, because you can make numbers sing and dance. Wall Street does it all the time. Well, apparently politicians can do it too. And here's the chart. Now, if you look at this and you start from some miscellaneous number, which, it says basically months in office, and you can say, all right, months in office, Donald Trump got in and there was a percentage gain in job growth. And he got up to, right before COVID, it was like 4.5%, something like that, over his tenure, over 3 years. Great. Well, that's a pretty good job growth. And then, of course, you had COVID, and it was down like 14% or 15% in total. And then it came back, so it was only down 2% from the start of his thing. Now, I don't know about you, but politics aside, and I'm not using this for a political thing. I'm using this for the stupidity that people put out there.
They all do it. This is not partisan.
Yes, it's not partisan. Everyone does it. And we all get baited by it because we see a visual chart and we're like, oh, it must be true. So let me just rip this apart for the listeners so you can see it. It's like, well, it looks like COVID happened, which we all know, but Trump's job growth was still negative. Wow. But look at Biden. When he started, his job growth is off the charts. and it's up like 10%, or it doesn't even have a number where his thing is. And it's like, okay. And so I'm looking at this, I'm like, Biden's job boom outpaces Trump was the title. Like, okay, is like, what are we really looking at here? It's like saying, it's like looking at Obama, who got elected at the pit of the economic global financial crisis, and saying, look, all the stock market gains happened because of Obama. Like, I mean, I'm not saying he didn't have some part in it, but he wasn't the reason the stock market went up. It's like getting in at the top and saying it's this person's fault the market crashed, and it's at the bottom saying this person's it's all because of this person because the market went up. The presidents have very little to do with the economy and the markets. They have something to do with it, but very little. And we all heap this we put this crown of shame or glory on the person's head as if they had something to do with it. I mean, I was just scratching my head thinking, like, who put this together and thought this is a good idea? This is glorious. Yeah, this is totally apples versus apples kind of comparison. And so I think the thing to keep in mind is every time you see these kind of charts, just ignore them. It's just head trash. I use these things to laugh because I get a lot of humor out of these things.
I like sending these, these things between each other because, sometimes I'll send, we'll send back and forth intelligent charts, and then sometimes it gives us the humorous talking points. And if you bring it back up for me really quickly, Kirk, on that one, the reality is, and again, this one is so egregious, right? Because we talk about a lot of Trump, chart crime. Maybe they'll use only a couple years to show some point versus using like decades. But I mean, the reality is this: you're talking about when, and again, not partisan. This is just the time they were there. So, don't skewer me if I sound pro-Trump or pro-Biden. But the point on this is that really the blue line, or I think it's blue-gray line for Joe Biden, that line starts at the point that Donald Trump's line ends. So where did that line really start? Well, down at the bottom of the -10. So the momentum of the job growth, as you can tell, if you put that chart into a linear fashion, had already begun the momentum. So it's being taken for, and you have to understand this with things that are being put in front of your face every single day. It is being taken and it is being constructed to create a message to you with a motive to it, right? And the motive is, look, we've never had job losses. We started at 0 and grew from here. Yes, you started at 0 under your tenure, but the job growth had already begun commencing. Surprise, Kirk. The instant we stopped the lockdowns.
Yeah.
Whoa.
Imagine that. You stop the lockdowns, we get job growth. Who would have thought?
What a flipping concept.
Who would have thought that?
Moving on.
Yeah. So, but yeah, I think it's just so instructive to talk about, minus the politics, these kind of things, because we see them all the time, right? And typically the president, if they have any impact, it usually takes like 2 to 4 years to see it in the economy anyway. So, and this isn't partisan. It's every president, and presidents get skewered and they get regaled as being geniuses, and very few of them have much of an impact. And some have. I mean, let's be honest. Some have because there's some huge program they did, but most of them it's not, right? And right now, job growth isn't our problem, right? We have a very low unemployment rate. Job growth is not the problem. We don't need jobs. Actually, if anything, we need fewer jobs because we need a higher unemployment. And you might think, well, that's stupid. Why don't we want to have people have jobs? Well, let me explain it to you for a second. So if you have a bunch of open job openings and you can't fill them, right? It means that we need more people. So this is where like the Republican Democrat thing of illegal immigration kind of gets a little skewered, because both parties want illegal immigration because they want the cheap labor. And we as a country need immigration in order to keep growing. Because if we didn't take any new people, we would be France, which is basically a flat to even declining population growth. Now, if you look at countries like Japan, France, there's a bunch of European countries, I don't know off the top of my head that what their statistics are, but there's a bunch of countries that have flat or declining demographics. And when you have that, it basically means that the economy is starting to shrink because fewer people are in the economy, fewer of them are generating productivity and growth and all the things the economy needs. So when you have a shrinking population and a shrinking economy, it means that you're having less money and then valuations decline. So everything starts to shrink. So the US economy needs to keep growing if it wants to continue growing as a whole. If we stop growing demographically, if we stop growing like immigration wise, so basically the demographics are flat or negative, it just means our economy is going to stagnate. And unfortunately, our whole economy is based on growth. If we didn't have leverage, right? If we didn't start, if let's just assume for the moment that our country didn't have any sovereign debt. No one was borrowing money. It was just there was no such thing as debt, and you just had assets. Let's say for a moment that's what it is. Everyone just had cash and assets, and the country is stagnant. We would be perfectly fine. There would be no need for any sort of debt because we're not growing. We're just money's shuffling around. Some things are growing, some are shrinking, but effectively it stays the same. Now, the point of debt is it helps money in motion. It creates inflation, which causes people to put money to work. So you don't just stick your cash under the mattress. If you have Japan, well, in the last few decades, if you had Japan where basically you have deflation, cash under the mattress is great. So if you have cash, it's worth more tomorrow than it's worth today. So why would you use it? Just put it under the mattress. It'll appreciate in value. And so in order for the country to take that cash out of the mattress and force it into the system so it's productive, right? You're lending money, you're borrowing money, you're starting businesses, you're doing this, you're doing that. All the things that cause our economy to grow. That's why they push this small amount of inflation. And I don't agree with the Fed on this. Like everyone has their own opinion, but I'm just saying I'm explaining why they're doing it. Right? I'm not saying it's good or bad. I'm just saying this is their thesis of why they're doing it. As long as we have some inflation, it causes the economy to move forward. Not large inflation, just small enough so it causes the money to keep circulating in our economy. So when you have this, it's really important to understand that we need to have immigration in order to keep that going. So now, if you have if you have tons of job availabilities and no one to fill them, that means there's growth that's not happening because you can't fill it with people. So you don't want a low unemployment rate of 2% or 1% or 0. You don't want that. It's terrible. You need enough slack in there so that it's got like a margin of error. So you can say, well, maybe it's 6, maybe it's 4, but we're trying to hit 5. Okay, that's a good number, right? Then COVID screwed everything up, obviously. A lot of people retired and didn't come back in. So it's all messed up. But the point is you have to understand the impact of this is not just getting more jobs. Like, I think the government should lay people off so they can go get real jobs, fill the real jobs that are out there. We don't need government employees. We need private sector employees because there's jobs that need to be filled. Who needs more government jobs? No one. No one needs them, right? We don't need more government people. We already got way too many of those, and we have more politicians than we need as well. I did want to point this one thing out. I'll hand it back to Doug. So there's this chart I found today, which I think illustrates what's going on in the Santa Claus rally. Now, this is the American Association of Institutional Investors, I think, AAII. And what they do is they do surveys, and this is just like, bulls versus bears, right? So on the high end, it means it's bullish. On the low end, it means it's bearish. So if it's on the low end, it means people are super bearish and they think the market's going down. When it's on the high end, it means that the market's going up and people are super bullish. Well, obviously, we're close to, for the last 5 years, we're close to the high point. And so if you're looking at this chart, what you should note, I'm sorry, individual investors. I don't know. Doug just reminded me. I said institutional investors, individual investors, American Association, individual investors. Got a Friday quirk in my speech here. So the thing to note is when it's on the high end, it means it's probably not going to last there that long. And it's on the low end, it means it's probably going to last there that long. It means it's overbought or oversold. Here's another example of this in a similar chart, different chart, but similar construct. So this is this is the S&P 500 percentage of stocks above the 50-day moving average. Okay. Now, what does this mean? This means that there's a 50-day moving average. Of those of you who haven't listened to the show long and don't know what technical analysis is, a 50-day moving average is basically the moving average of 50 days of prices, right? So if the stocks are going down, the moving average is going down over 50 days. If the stocks are going up over 50 days, the moving average is going up. And so it's a technical indicator that people use to say, all right, we're approximately right around this point. So when you have 90% of stocks in the S&P 500 above their 50-day moving average, it means 90% of stocks are bullish, right? It means that they're in a bullish trend. And if it's 10%, like it was a few weeks ago, it means it's in a bearish trend. Now, what happened a few weeks ago is it was in a very bearish trend, and then it shot up instantly in a few days. As you can see here, it went to 50% within like a few days. Now it's at 90%. Now, it's hard to get to 100%. I'm not sure how high it's ever gotten, but 90% is kind of the cap. So when you hit 90%, you're like, all right, we're probably going to start to reverse trend here. Now, I'm not saying it's going to happen today or tomorrow, but we've got 2 weeks left in the year. Now, if I'm a betting man, and I'm not, but if I'm a numbers guy and I wanted to make a calculated bet, I'd say a good time to short the market is probably January 2nd, right? Or December 31st, depending on when you can get it in. And short the market because it's maybe not long term, but short term, it seems like we're going to have a little bit of a pullback here. Now, that could happen now. As we're seeing today, the markets as of today have been negative, so it could be happening now. It may not be 2 weeks. It could be that the markets come down a little bit, retest where they were a few days ago, and then they start to climb again. And that could happen too, right? We don't know, right? But the point is just be mindful of the extremes in the markets. Extremely bullish, extremely bearish. Neither one is good, right? And all it means is it's a likelihood that it's probably going to go in the other direction if for no other period, at least a short period. If it happens in a short period, it means it's probably going to continue in that direction up. If it happens longer, then obviously you don't want to be in the market. But it's a time to be careful more than anything else. So, Doug, what else you want to discuss? We got a bunch of charts here today, but trying to discuss bullish stuff.
Yeah, no, it's you really do. Sorry, I trying to pull up the different charts we had for a second here. Sorry, Kirk. One of the things that we talked about that we kind of started to talk about last time, and may have touched on it, and you just did. I just want to kind of reiterate that is again kind of similar to that job growth chart. We call that a chart crime. Just remember that there's also again, not to throw anybody under the bus, but media crime, right? What you get, those little snippets. So about, last week or the week before, I think we touched on this a little bit, just a reminder that they were talking about the massive job growth. They beat expectations. You just touched on private sector versus public sector. Historically, about 17% of the jobs that had been hired on average over the last 10 years were in the public sector or public and healthcare. Okay. That just spiked to well over 40%. 40% of all jobs they hired in that jobs report went to government positions and went to healthcare. Okay. So it sounds great at the surface level, right? It's a media statement. Look, we achieved and exceeded the expectations for hiring and jobs. But what is the data that's making that up? What's the breakdown that's making that up? And when you start to see that that the jobs and healthcare is run is similarly like the government in a lot of ways. I mean, a lot of your healthcare jobs are, for example, around here we've got Hennepin County Medical Center, right? So there's a lot of medical jobs that actually are directly or closely indirectly run by government, but they're also, because of insurance, because of medical need, because of a number of other things, the way they run, it's not really a recessionary type of business. I mean, health, if you could argue, it's almost recession proof because health tends to degrade as people become stressed and other things happen. But when you see that much of a spike of jobs going to those two sectors, it really can be, I'm not saying is, but can be a telling sign of a little bit more concern around what's going on in the private sector. Another chart that I think I pulled up this morning, Kirk, I'll just kind of switch on. We've talked about this before. I'm trying to be bullish conversations here, but I'm looking at the charts that I'm seeing and that have been coming out. We keep talking about debt. We keep talking about credit card debt and mortgage debt. But just to touch on this, we haven't really discussed the impact of debt outside of the United States. This chart, this chart that I'm referring to here, you can really see, and again, there's a little bit of variance because at the significance of the increase over a shorter period of time makes it to where it's very hard to see how much in relative the growth was in the early years. But if we go back to looking at world debt, not just domestic debt, but world debt, and we look at what happened from 1972 to about 1997, it started to take off and at least rise at a greater level of expansion than had previously been the nominal increase prior to that, at least on this chart, which looks like it goes back to like 1952. But since 1997, oh boy, I mean, the rise is to the point in which it just throws the whole chart off. So, when you talk about leverage, when you talk about the ability to keep buying goods and services, you talk about the ability to grow the economy by adding jobs, to grow the organizations, grow the government, to continue to fund these type of things. We've said it before. There's a significantly greater amount of that now that is being constructed on the foundation of debt and leverage. It's not being constructed on cash. And again, if we go back to, and this is not bullish or bearish, right? Because in some ways, the ability to be able to take on a greater level of world debt has, when managed appropriately, allowed for a greater level of prosperity at the global scale, right? It's allowed maybe access to areas in third world countries that previously had a much more difficult time being able to grow their economy, make infrastructure investments, and again, that's on the public sector, on the private sector, companies inside of those of those countries being able to have access to capital to be able to grow. America was built on the flexibility of being able to use leverage strategically in order to be able to make investments that hopefully and ideally end up becoming a positive return on that investment. Now, you could debate whether or not the utilization of that leverage has been continued to be done in prudent fiscal applications. You could argue whether or not there's been a return on the investment. And we've seen a chart we looked at last week. I think Kirk was last week or the week before. The number of potential companies that are getting closer and closer to risk of bankruptcy tells you that there is some question marks on the amount of leverage and the ability for those companies to be able to continue to manage that. We know what's going on in the banking sector. So there's definitely, and of course, personal leverage, government leverage. There's definitely a lot of negatives that come from the rapid expansion of that debt. But I also wanted to be note that there is also positives that come from that, that could be going to the chart. Say it's not just bad debt. It could be, again, a representation of a greater global access to money and capital to be able to do things that are actually helping to expand prosperity. And I love what you brought up here, Kirk. So I'm going to let you talk about this chart. But this is definitely an interesting chart when it comes to where we are with the U.S. and our own debt and what that means in comparison to the things that we have to finance. So I'll let you talk about this one.
Yeah, so I'll talk about this a little bit. So if you look at this chart, it's basically the chart is showing the defense budget versus debt service, and so if you're looking at this, it's basically just showing. I mean, the defense budget, as we know, obviously is always been pretty high, right? And as the global world police, as the South Park Trey Matt and Trey Parker, or Matt, I don't know. I forget the other guy's last name, but
Trey Parker, Matt Stone.
Yeah, Trey Parker and Matt Stone. So those guys who did like Team America, World Police or something, it was great movie. I always get comedy out of that. But if you look at the U.S., I mean, the defense budget is always huge. But if you look at what's happening now, the debt service is also a huge part of our budget. And so your dollars that you're paying for taxes are in large part going to debt service. So if you look here, it's spiked in the last few years. It's gone up about 50% in the last 2 years, and we're just getting started. There's a whole bunch of debt coming due in the next 12 months, and maybe that's Powell's idea. Like maybe we'll just start dropping rates so we can refinance the debt so it doesn't get too expensive. But it's going to get a little scary. I mean, the debt service next year is going to go through the roof, and what does this mean for you? Well, it either means it means a bunch of things. First of all, it means that the government probably doesn't care, and they're just going to keep printing money because they can. So that global debt is just going to keep skyrocketing because they have to pay for this debt. Another thing it means is taxes may go up, although I think that's probably less likely. If you really want to start a recession, it's a great way to do that. So no one wants that on their watch. Although both Trump and Biden, whoever won, it would be their second term, so they might not care. But realistically, if your taxes go up, that's gonna put a squeeze in the economy. It could mean that the other services that the government's paying for decline. I think that's probably unlikely. They got to pay off their constituents, so they, as the government typically does. So that may decline a little bit. There may be less of that. But ultimately, I think the answer is they're just going to print more money and inflate the debt away over time, and that just causes this problem to get worse and worse. Because what happens if you got new debt that's coming out at these high prices? It means that the debt service keeps going higher. It's like imagine you have a credit card, and then you fill it up, and the rates go from like 6% up to 30%. And you're like, well, crap, I can't pay the bill every month. So then you go get another credit card to pay off the interest payments of that first credit card. So every month you get the interest payments. So I can't pay that. You put it on the other credit card. Eventually the other credit card gets filled. Then what do? Well, I'm going to get another credit card and put the interest payments on that. But as you get more and more credit cards you fill up, the amount fills up quicker because the debt service on these earlier credit cards are the same. But now instead of one card, now you got two. So you got twice as much you have to pay every month. So in the third credit card, now you have half the time you had in the last one to fill it. And then the fourth one is even shorter. So at some point you got to start getting two credit cards at a time, and then three, and then five, and you keep going. And the government, as a person, you don't have the ability to do that because at some point the banks just shut you off. They're like, yeah, you're an idiot. We're not giving you any more debt because you're just going to go, you're basically going to go default on it. So we're not giving you any more money. The government can do this. The government can do this as much as they want. They can keep printing money until the world stands up and says, we're not giving you any more cash, right? So we're in a precarious position as a country in that the future of our sovereignty, of our independence, of our economic prowess, if you will, is going to come to an end because of one simple word: math. It's math. It's I would also call it political stupidity, but it's just math. At some point, the numbers stop working, and people come to the table and say, "We don't trust you anymore. We're not going to lend any more money," and now you're in deep trouble. That's why over hundreds of years, these countries have lost their status as the world's reserve currency. Right? You have England, you had Spain. The U.S. isn't quite there yet, but you had a bunch of countries that were in that boat. And I think where was it? Norway. One of the Scandinavian companies did at one point too. So if you go back far enough, there's a bunch of countries that were there. But you lose it. The same thing with ancient Rome. They lost it because the currency was no longer trusted, and people said, "Yeah, we don't trust you. We don't want your I forget what they're called, the ducats, not the ducats, but the coins." Solidars, I think is what they were. But the ancient Roman coins, people said, yeah, we know you're not, those aren't real gold anymore. So we're going to use something else. And that's how countries fall, because of the economy. Who was it who said it's the economy, stupid? Like, it's true. It's the economy. You can blame it on, wokeness. You can blame it on demographics. You can blame it on whatever you want. It's all economics. Economics is what runs the world, whether you like it or not. And
James Carville.
Yeah.
1992.
Yeah,
Yep.
Carville before he sounded like an idiot, like he did on the on Bill Maher's show the other day. He just sounded like he was drunk or something. But anyway, he's fallen far. He used to be a pretty sharp guy, but he didn't seem too sharp in that show. Anyway, I'm just gonna make one point here, just because I want to jump on the bandwagon before we head off, and I'll let Doug close it up. So I'm going to share this wonderful chart for all of those who experienced the wonderfulness of the presence of some of the top college institutions this week, basically showing how ridiculous they are. I think they all hired the same PR person, and that PR person should be burned at the stake, because these people sounded awful. And if they truly believe this, they should probably be burned at the stake, because the marks they made were just beyond awful. Anyway, I also wanted to harp on this because why not? Everyone else is doing it. Here's this chart shows great inflation has been hitting all-time highs at America's top institutions. And this shows Harvard. So back in 1950s, the average GPA in 1950 was about 2.55, let's say, right? That was the average GPA. 1960s was a sharp rise. People characterizes because people wanted to avoid the military draft, so the GPAs went up, so they made sure they were staying there, whatever. Since then, it kept going up. In the class of 2022, the average GPA of the graduates of the class of 2022 was 3.8. And this is not on a scale of 5. This is on a scale of 4. 3.8 was the average GPA of Harvard's graduating class of 2022. Now, I don't know about you, Doug. They might find the best and the brightest, but there's something wrong when everyone's getting a participation trophy. Sorry to say. Everyone is not, what's Lake Wabagon, where everyone's above average? Well, apparently everyone in this class is above average. So it's like, you figure that one out in your head if you haven't heard that one before. So anyway, I just wanted to leave that before we wrap it up. Doug, where can people find more about you?
Listen, Kirk, a couple of things. I could go down this road. You know this because that's what I do. Is college planning, and if you're out there listening to this and you've got a kid, then you're like, my child's got a 3.8, 4.0. I can get in anywhere. The reality is, most of your public schools these days, the average incoming GPA of a public school is going to be 3.75 or higher. Okay. And for many of them, it's actually shocking to see that the average GPA coming in is over a 4 point. Unfortunately, GPA is almost become irrelevant. It's still focused on, but it's almost become irrelevant as a way to stand out for colleges. And there's so much more that you need to do to stand out. So you think, hey, I got a 4.0, they're going to get all these scholarships. That's not happening. Okay. There are ways for you to still get the scholarships. There are ways for you to still get the discounts. And listen, we just talked about debt, and I want to just say this really quickly on the government. If the government was, let's just say they're bringing $1 in of income and they had a $2 cost, which is pretty much the U.S. government, okay? And let's say the military was 50 cents of that, and interest was only 20 cents of that, okay? Once that interest rate goes up to interest payments goes up to 50 cents, the cost that the federal government had to pay goes from $2 against $1 in income to $1.30. But that's a problem because that's 30 cents more that they're in the hole. So to $2.30. So that's 30 cents more in the hole. So guess what? That means that more debt means more interest. This is a downward spiral. And this is the reality for a lot of households. So again, we go back to GPA inflation. We go back to tuition inflation. We go back to thinking you're going to get scholarships and figuring out how you're going to pay. And most of America has dealing with cash flow issues. Even if you make tons of money, you probably spend tons of money too. The reality is that there are ways to get and understand this complexity. There are ways to stand out. There are ways to get your child a good education. But if you don't do this right, you're going to be in the same potential boat as our federal government is right now with debt. The only difference is you as a family, you can't print money. So if you don't want to figure out how to try to print money illegally,
we don't recommend that, by the way.
We don't recommend it. And I really highly encourage you getting, intellectually armed. Go to our website, procollegeplanners.com. Download where I think we've got the key numbers for next year. We're going to be uploading the new key numbers here shortly for next year as they come out. But also go take our free college money report. Find out how much you can afford. Find out how much the colleges think you can pay. Find out what scholarships might be out there. Some suggestions up to 3 schools. Do it right now. ProCollegePlanners.com. And if you have questions, info@ProCollegePlanners. Listen, you can't afford not to do this.
Great. Well, Doug, thanks for coming on the show and sharing your wisdom with us. And that's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Also, we're now on YouTube. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send him an email, express your feelings. If you're seeking financial advice, talk to an oracle or fortune teller or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.